Okay, thanks everyone for coming. With so many interesting events going on in the energy sector, it's very timely that we're here today. We have a pretty distinguished panel from various aspects of the energy industry. Joe Kleinman from Sempra is a senior trader there. Salish, how do you say it? Buddha?
I think we just leave
it. Not sure, but from Citigroup, involved in the risk area there. We have Rob McAndrew from the Chicago Climate Exchange, and Bill Hederman, who's a senior executive director from Morgan Lewis Energy. With that, we'd like to just go right into the discussion, and I think the first speaker will be Joey. He'll talk about just basic trading philosophy and his area of trading at Sempra. Thanks.
Hi. Basically, my understanding of how we'll run this tonight was, very brief description of some of the issues that the energy markets are facing, and then we'll have lengthy Q&A. And so, to a certain extent, I'm not going to offer many answers right now. I'm just going to sort of pose some of the questions and issues that the energy markets are facing on a practical day-to-day basis. One of the first questions that comes to mind is, who are the participants? Who are the people who are actively trading in the energy markets today? And it's a pretty short list if you categorize it the way I have. You have energy producers and consumers, the traditional people who have to be in the market. They're going through some very interesting times as they experience the perils of hedging, which is quite a serious problem for a lot of the people who are in the real world of commodities. Trading companies, which are in a very interesting situation in that for many, many years the trading companies have dominated the commodity markets in which they trade, and for various reasons, which I'll get to in a moment, you can almost say that they're experiencing a loss of dominance. They're certainly still the dominant players in the physical energy markets, but as financial engineering and derivatives become more and more integral in the markets that we're trading, the physical players are sort of losing the stranglehold that they once had on the marketplace. Hedge funds. Hedge funds are becoming increasingly active in the energy markets. This is driven, I guess, by two things. The first is they're just looking for something to feed the machine, something that will generate returns and yield. It's a relatively interesting space that still has plenty of arbitrage and relative value opportunities, which are the trade of most of the hedge funds. At the other end of the extreme, I myself have only recently become aware of this. There's a tremendous participation in the markets by outfits known as prop shops. The day trading of the 1990s .coms has given way to prop shops where you have rows of people sitting at desks paying their little bit of money to come in and spec futures. And with the advent of electronic trading, the access to these markets is unprecedented. And on a day-to-day basis, if you look at the volumes going through on the electronic markets, it is astounding to see how many tens of thousands of lots can be traded one lot at a time. I call this death by 1,000 paper cuts. And for professional traders, it actually leads to some pretty interesting market movements. And finally, the big beast in the market, with all due deference to our host tonight, passive commodity index investors. They have really changed the landscape. I'll move on to some of the transactional issues that the markets are looking at. The advent of electronic trading, as I mentioned before, everyone is a local now, and there are no locals. The transparency or lack thereof of the markets. It's becoming increasingly evident that the amount of activity that's going on not in public view is really dwarfing what happens on the regulated exchanges. The increasing number of ways in which you can trade essentially the same thing. Talk about WTI crude oil. You can trade the NYMEX physical contract, the NYMEX cash settled, ICE futures, NYMEX cleared swaps. you can access these markets through a variation known as TAS, which is really trading the same thing, but it opens some interesting things where you're trading at the settlement. E-mini contracts, over-the-counter swaps, options on the futures, options on swaps, same-day options, EFSs, which leads to a whole other area of arbitrage opportunities, ETFs. Anybody with a Charles Schwab account can, type in the ticker USO, and they've just bought some NYMEX crude oil, among other ETF vehicles. You have the continued growth, as I mentioned, the continued growth and development of the over-the-counter markets. You have massive global liquidity. And the question is, how do these markets accommodate this? Last week, Goldman Sachs put out a press release talking about they announced the weights for the 2007 GSCI. And in that, they said, the estimated level of investment in the GSCI and other commodity indices will be increased from the current level of $70 billion to $110 billion, effective January 2007. So sort of put that into perspective, on October 31st, the open interest on the NYMEX crude oil contract was 308,000. If you want to lump in the ICE futures contract, that's an additional 144,000, which gives a total of 452. Given the current weight, and the weight for crude oil will go up next year slightly in the index, in order to hedge $110 billion notional of GSCI exposure, you would need approximately 570,000 contracts, so more than the total open interest of the listed exchanges in those contracts. And so clearly, the amount of, the size of the iceberg that isn't visible is relatively large relative to what can be seen. There are, of course, the fundamental issues that the market faces. Peak oil debate, which is basically Pyra versus Syrah. Are we about to run out of oil, or have we, do we still have plenty coming? The world is dealing with the growth of, the BRIC countries, Brazil, India, China, and their seemingly, insatiable appetite to start consuming. How dare they? They want to consume at the same level that we do. The geopolitics of energy, Iran, Mideast, Nigeria. You have the issues of projects that are being developed globally that are being competed for. India and China are in a massive race to make sure that they have adequate supply for their expanding economies. And you see this very interesting competition in the deal flow for E&P worldwide. Increasing costs of production, oil sands, ultra-deep water projects, things of that nature. In addition to the traditional energy markets, you're seeing the market develop new strategies for coping with this changing world. You have the advent of LNG, liquefied natural gas, which is the globalization of the natural gas market. Coal as a traded commodity is becoming much more prevalent. Biofuels, ethanol, and biodiesel, also two very interesting areas that are under development. And sort of alongside these, even though they're not per se energy markets, and that you can't actually run your car on carbon or NOx or SOx, they are becoming a very large part of what's going on in structuring deals and in trading in these markets. These are just a very quick list of some of the issues that the markets are facing on a day-to-day basis. Thank you.
Okay, thanks a lot, Joe. Okay, next let's hear from Rob McAndrew from the Chicago Climate Exchange. And then, as soon as we're all done, we'll have questions and answers, talk among ourselves and the audience.
Thank you. I'm going to focus on the emissions markets. The Chicago Climate Exchange operates markets for trading SO2 emissions allowances under the EPA Clean Air Act and greenhouse gas emissions. Our sister exchange, the European Climate Exchange, trades futures and options contracts under the EU ETS system for trading European carbon allowances. Both CCX and ECX are owned by Climate Exchange PLC, which trades on the AIM division of the London Stock Exchange under CLE.L. I'm going to spend most of my time talking about the global carbon market, greenhouse gas emission market, and we'll touch on the SO2 market at the end of the presentation. Sir Nicholas Stern, a former chief economist of the World Bank, recently published a 700-page report detailing the economic consequences of global warming. His conclusions are that world economies could shrink by 20% as up to 200 million people are displaced by either drought or floods. Actions to reverse the trend of growing greenhouse gas emissions would cost about 1% of global GDP. Stern favors market mechanisms for counteracting, for sending price signals, for investment in technologies, and for trading. Smart money is starting to flow into what we call the carbon space. Last week or 2 weeks ago, Morgan Stanley announced that it would be investing $3 billion over the next 5 years to beef up its trading efforts in the global emission markets. Goldman Sachs, our host, took a 10% position in Climate Exchange PLC. GE is out with their Eco Imagination. Jeffrey Immelt, the CEO, is proud and clear when he says green is green. Walmart is talking about requiring its suppliers to supply carbon-neutralized products. So the global market for emissions and emissions trading will be quite large. Estimates of the size of the global market vary. From the World Bank, The Economist, the U.S. Council on Foreign Relations peg that market, the global market, at somewhere between $100 billion and $2 to $3 trillion in the next 5 to 10 years. Through 3 quarters of 2006, the global carbon market grew to $22 billion, more than doubling from 2005. The European market, which is the EU ETS, makes up the lion's share of that market, currently trading about $19 billion worth of allowances. Through September of this year, the EU traded 765 million tons of carbon compared to 325 in 2005. So again, a doubling in volume. If you take a look at the size of the European market, the total allocation of emission allowances is 2.2 billion allowances, covering 1,200 installations, and makes up about 40% of the emissions in Europe. At $20 a ton, the underlying value of the European carbon market is bigger than the U.S. grain markets consisting of corn, wheat, and soybeans. So again, these markets could be significant. The European Climate Exchange, as I mentioned, markets futures and options contracts for the EU allowance program on the ICE futures platform. It commands about 40% of the total volume. A large part of the volume in Europe trades OTC and covers about 80% of all exchange-traded volume. In the U.S., the U.S. did not sign the Kyoto Protocol, and currently there's no regulation that requires U.S. entities to reduce their greenhouse gas emissions. But that appears to be rapidly changing. A few months ago, California passed a very ambitious law called AB 32, under which California is taking a reduction commitment to reduce emissions to 1990 levels by 2020. That's about a 20% reduction, and ultimately to reduce 80% below 1990 levels by 2050. Here in the Northeast, you've had 7 states, soon to be 9, that have created a regional greenhouse gas market, which will require utilities to cap their emissions and trade allowances. The cap there will be 10% below current levels. Governor Schwarzenegger has directed California officials to explore ways to link the California market with the regional greenhouse gas initiative in the Northeast and to any other markets that may exist, including the European ETS. However, given recent developments in the political arena, that will probably be preempted by a national scheme. Currently, there are 6 or 7 pieces of legislation before Congress. 3 or 4 of those are bipartisan in nature. Olympia Snowe and John Kerry have put forth a bill to cap and trade greenhouse gas emissions. Jeff Bingaman and Pete Domenici and John McCain and Joe Lieberman are 3 examples of those bills. Barbara Boxer takes over the chair of the Senate Environment and Public Works Committee, replacing James Inhofe, who is famous for, among other things, calling global warming the greatest hoax ever played on the American people. So there's a real shift in the thought process coming on in the government. The only existing market for trading greenhouse gas emissions in the United States is the Chicago Climate Exchange. Year-to-date CCX volumes have picked up dramatically. Historically, the program started in December of 2003. In 2004, we traded roughly 2 million tons. Last year, we saw another 1.5 million tons traded. This year, year-to-date, we've traded 9.5 million tons. The price of carbon on the the CCX exchange has risen from $1.50 in January to over $4.25 currently. The CCX has grown from 14 original members to over 200 plus. Some of the members include American Electric Power, IBM, DuPont, Ford, International Paper. We currently have 6 cities as members, 2 states, New Mexico and Illinois, and 6 or 7 universities. In terms of the other emissions markets, in the U.S. has emissions markets that are operated by the EPA. Joey mentioned the SOX and the NOx markets. The Chicago Climate Exchange currently trades a futures contract for the SO2 market. We're looking at listing at some point a futures contract for the NOx market. Market prices in the SO2 emissions are currently around $500 a ton. Market has shown significant volatility in the last couple of years. 24 months ago, these SO2 allowances were trading in the range of $200 to $300 per ton. In December of last year, they traded as high as $1,600 a ton, and as I said, they're currently trading at $500. So there's significant volatility in that market. That's basically my comments with regards to the emissions markets, and again, hope to address more of it in question and answer.
Okay, thanks a lot, Rob. That's clearly, Chicago Climate Exchange is a very unusual exchange, and it's growing dramatically. And if anyone could just, well, I'm sure people are aware the stock price has really gone up a lot. People are finding value in it, and you can just see it by the way people are investing in the exchange with Goldman's purchase of 10%. Salish?
Mine is going to be much more pedestrian. The risks which I focus on in the energy markets is primarily the market or price risk. I look at the counterparty or credit risk, the operational risk, the operations risk, and the model or valuation risk. All of these are interrelated. The biggest problems we have in the energy markets are that they're highly fragmented. There are a lot of transactions which are done over the counter. The transactions which are done on exchanges and which are reported, on which statistics are collected, are very few, and they do not represent the full market. So price discovery process is really, really difficult in the energy markets. So when you have prices which are not really reflective of the economics of the dynamics of the markets, any models which you build for assessing risk or the value, you have to be extraordinarily careful to make sure that that the model which you built probably has a very high degree of error, and so whenever you want to do any position taking, you want to keep that in the back of your mind. In the price risk, the other thing which is a characteristic of the energy markets is that most of the transactions are concentrated in the front end. Most of the liquidity, most of the transaction volume is in a few contract months. So after 12 months, the liquidity basically disappears. So if you're doing a long-dated transaction or you're trying to do a structured transaction, then you're building up models based on very short-term price behavior and try to extend it in the long run. So that again creates a lot of problems of itself. Then you have what is called seasonality. Seasonality is something which most financial markets, you do not see seasonality. So trying to take a model from the financial markets and then stick it into the energy markets can lead you to really bad results. And you think you're making money, but on a realization basis, you realize that you're losing the entire position. Market disruptions. Market disruptions can be pretty significant in the physical markets. Last year when we had the hurricane, Katrina and Rita, the pipelines were shut in Louisiana. So a lot of contracts are indexed to those pricing points. So clearly, you could not deliver. You did not have a clearing price, and the contracts did not have a mechanism to arrive at what would be an appropriate alternative index. So you had a lot of disputes, good for the lawyers, but bad for the companies. Model and valuation risk is very, very significant, both for valuing a transaction, but also for developing risk models like value at risk, for instance. You cannot assume that distributions are log normal or the returns are normal, joint normal. You have power prices which exhibit lots of what you call discontinuities or spikes. So the question is, how do you incorporate those type of behavior into your value at risk models? Setting up limits. What is an appropriate limit to set for your business when you do not know what is the size of the market, you do not know how liquid it is except for the front, and your traders and your structures want to do 3-year, 10-year, 20-year transactions. People want to do 20-year natural gas prepaid transactions. Question is, what is the market risk associated with it when you cannot really hedge? You have to do it. People say, oh, well, we will do, stack and roll. Well, stack and roll can be extremely expensive, as some of us have found out. Also, how do you assess the credit risk of your counterparty over a 20-year period? Well, in the financial markets, they say, well, you can buy a credit derivative. But you cannot buy credit derivatives for many of the counterparties in the energy markets because A, they do not have liquid bonds or trading. They're probably subs of associates or affiliates. So it's very, very difficult to manage the credit risk associated with it. If you're a bank like our bank, credit risk is extremely important for us. So assessing what is the counterparty risk when you're doing such long-term transactions becomes extremely critical. Then there you have what's called the operations risk, which you do not see in the financial markets. If you're a physical player, then you have a lot of delivery risk which you do not see in the case of the financial markets. You can settle by paying cash, but in some places, some customers will not take cash. They will say, give me the molecules. For instance, if you're a local distribution company and I've agreed to sell you gas for delivery in December and it's a very cold day, I cannot tell him to go and buy gas in the market. He says, no, you deliver it. I want the gas delivered at my city gate at this point in time. If you are doing, let's say in the power markets, if you do what's called a tolling deal where you take the risk, you say, okay, I will buy power from the producer at a pre-existing what you call a contracted heat rate, which is a conversion of the fuel into power, then you run into the risk when the unit goes down and you have what's called a forced outage risk, which is something which you never see in any of the financial markets because financial markets do not have any of those operations risks. So if you're a financial institution and you're trying to model, let us say, a tolling deal or a storage transaction, a gas storage transaction, remember the constraints which are there associated with these types of transactions are very complex, very intricate, and trying to model is very, very problematic. Most often you cannot use an analytic approach because especially when you want to incorporate the constraints. So once you model it and then you try to say from there I'll take the parameters or take the outputs and then stick it into a value at risk where I assume everything is normally distributed, 95% confidence interval, etc., you can lose your shot. So there are lots of risks associated with it. We are still at a very infant stage in risk management in the energy market. We know how to manage the physical risks, but when it comes to the financial risk, we're still at a very preliminary stage.
Thanks a lot. Bill?
Hey, thanks, Randy. I'll change gears some here too as the last speaker. The reason that I was asked to join this panel was not because I'm at Morgan Lewis right now, but because until pretty recently I was the top cop at FERC, the head of the Office of Market Oversight and Investigation. So I'm going to try to bring a perspective about how the regulations apply to what's going on in the industry, and that's what I'm doing for Morgan Lewis's clients right now too, so I'll share that with you. I was asked here before Election Day, obviously, but Election Day really makes this an extraordinary moment for the energy markets and for market participants. I think the changes that are already underway in Washington, can say with high degree of confidence they will change the energy marketplaces. I personally expect that the benefit of the doubt that's been extended to the markets in the recent past after all the progress in the post-Enron world will not be enough for the policymakers that will be in charge going forward. And I should caution that, as I mentioned, what I personally think, that I'm speaking on my own behalf and not on behalf of Morgan Lewis or our clients. So for almost a year, essentially the full time since I left FERC, I've been warning industry that industry needs to take the lead on putting more assurance of market integrity in place, or the policymakers will take the lead, and that will not be a superior outcome for any of us. I think time is running short on the option of the industry lead, and I think that an organization like IAFE, as a place that can set professional standards, is one avenue that should be thinking about what role they could play. Several energy companies have constructively engaged on this challenge of how do you comply with FERC rules, with CFTC rules, and in many cases contradictory state regulator rules. Makes for a lot of fun, and as Salish mentioned, it can be good for lawyers. I should mention I'm not a lawyer, which makes for adventures in a law firm for me. But there are also other initiatives underway. I expect some of you are aware of some of the financial institutions trying to pull together and create some standards and some policy propositions to put forward in the energy marketplace. The Committee of Chief Risk Officers that I worked fairly closely with in the past, and Salish was involved with as well, are trying to put forward some straw man proposals, and I think that taking a leadership role in establishing goals for voluntary transparency and trader and analyst professional conduct is still a need that deserves attention. But whatever the progress that the market players make, I expect that we'll now see Congress pursue further initiatives, especially on the transparency issue. And I expect also that we'll see pressure for acceleration on enforcement activities. The Republican chairman of the various regulatory agencies will be asked to show that they're making progress. And I'm sure there'll be oversight hearings, etc. And generally, chairmen like to go up to the Hill and announce some progress when they've been asked to do so. So I think there will be some pressure. There are activities underway already, and certainly I bet that most of the sharp observers in this room know that at least one power company had a footnote in their 10Q that talked about a FERC investigation. I think that most people realize that wasn't an ice cube, and it's more the tip of an iceberg. And that's certainly what I've been advising clients that it means. About a year ago, August of 2005, the Energy Policy Act was passed. It did not create a comprehensive energy strategy, but it did create a massive to-do list for places like FERC. And it did give FERC important new civil and criminal penalty authority. And it really transformed FERC from a backwater regulatory body that dealt with pretty arcane issues to a real enforcement powerhouse. And Chairman Joe Kelleher believes that this transition basically makes him something closer to an SEC-type regulator than a State Public Utility Commission-type regulator. FERC has the authority now to impose $1 million per day per violation penalties. That does deserve the serious attention of anyone active in the energy markets, and I think most people who are serious about playing in the market understand that now. But let me turn to some brighter news, because I think that even before Election Day, the market for savvy analysts was a target-rich environment. We've got the North American natural gas market. That's essentially a continental, well-integrated marketplace. And then that interacts with the power market. And sometimes what's going on in the gas market is setting the price in the power market, and sometimes it isn't. And that could depend on the region and whether there's a functional, organized power market, or whether you're in a traditionally oriented utility marketplace, or you're out west and there's a little bit of each going on, and the bilateral deals are where it's really at. And bringing sophisticated analysis to that and integrating that with bringing those fundamentals and the quantitative trend analysis together, I think can identify lots of arbitrage opportunities there and places to add value by closing up those bumpy seams between different parts of the markets. And as Rob mentioned, the environmental marketplace is going to also converge into that same space, coming not as much from the gas side, but coming from, if you will, the low-value side of the coal part of the fuel chain. And I think that that's going to make an immensely target-rich opportunity here. But as you move forward there as an old-time energy strategist, I think that the formula for you to succeed and add value for your company and also for society are really the same formula, which is first, scrupulously assure yourself that you're complying with the regulations and with ethical professional conduct. Secondly, proactively engage in the policy formulation. Help the regulators and the legislators get this right. And I think Goldman has been a real insightful organization on that. They've always made that investment to help the regulators and the legislators understand the implications of what they're thinking about. And it makes sense for other big players to do the same. Intensely analyze both the fundamentals and the quantitative side of things. I think the real opportunities are finding the differences there between the trends and the fads and the fundamentals, and then combine all of that to seize the honest and not manipulated opportunities. And I hope we can talk about what that distinction is as we're talking further. But if you effectively implement that kind of a strategy, I think you can generate a lot of value and sleep soundly at night. So thanks very much.
Thanks a lot, Bill. Okay, so to move it along now to questions and answers, I thought we'd just start with something that might be timely. We had prepared the energy conference prior to the Amaranth explosion, but we could possibly talk about Amaranth and how possibly price transparency or price discovery might have aided issues there. But also from Amaranth, a lot of people say, well, their investors read the PPM and it's their investors, but it's really the effect of what it had upon price movement just at the extreme and how it affected people in general. So possibly we could, among the panel, discuss a little bit what may have assisted in preventing an Amaranth situation and how it may, of course, we expect that there'll be other Amaranths down the road, but who at the panel might want to start with that? Anybody? Any takers?
Want to take a crack?
Yeah, I guess I'll have to take a crack at that one. First of all, to answer the last part of your question first, there will definitely be another Amaranth. It's just a fact of life that, in the world that we live in, sometimes people will, overstep the bounds of their capital base. And we've actually, it's not just Amaranth. Earlier on in the summer, there was another large hedge fund, Mother Rock, that also went belly up. And that's actually an even better case as far as I'm concerned, because if you believe the market scuttlebutt as to what their positions were that got them into trouble and the market moves that caused their demise, in the end, their play was right. The market went to a level that, had they still been in business, would have made them a lot of money. But, as we all know, as Keynes said, the market can remain irrational longer than you can remain solvent, and that's the nature of the hedge fund business. In terms of the earlier part of the question, I think that market participants were becoming increasingly aware of the presence of amaranth in the natural gas markets. Certainly to the professional traders, it wasn't a surprise when people started talking about them being in trouble. As opaque as the over-the-counter markets can be, and as opaque and anonymous as even the listed markets can be, there comes a point in time when the level of activity of one participant draws notice, and people start paying attention. And when people start paying attention, that can't possibly be a good thing. And what was interesting, in the time leading up to this, I had a very close friend of mine who called me up one day and he said, "That's it, I'm thinking about getting out of the business. You just can't play anymore." And I said, "Well, what are you talking about?" And he said, "Well, you have this one big guy and he keeps bullying the market and doing this and doing that." And by the way, I'm not accusing them of manipulation in any way. And I think it's interesting to point out that, to date, there's not been any accusations that their positions were in any way anything other than a P&L problem. No one has, to the best of my knowledge, no one has said that they were doing anything in the marketplace that was, manipulative or, improper. I think, they lost money, but they didn't violate any of those guidelines. And my friend said, you have this one big guy and he's coming in and he's, pushing these markets around with his big positions. And I said, yeah, but that's the way it's always been. There have always been big players in the marketplace. And he said, but this is different because now, it used to be that, in the good old days, if somebody came in and they, bought 100 contracts and bought 100 contracts, then bought 1,000 contracts and bought 1,000 contracts and pushed the price against me, I knew eventually they'd have to get out. And now, because the over-the-counter cash-settled, financially engineered derivatives market is so big, this guy comes in, buys it, and then, on the last day, the position just disappears, and money's exchanged, and that's the end of it. And I said to him, the market has its way of regulating these things, and the market will take care of it. No one is bigger than the market. And he said, oh, that's not true anymore. I said, well, I guarantee no one is bigger than the market, and they're not bigger than the market. And 2 weeks later, they were a lot smaller than the market.
Right, but would it have helped if there was more transparency, if possibly the over-the-counter positions could have been brought back to a cleared quantity that one could have looked at position limits?
Well, I think that a very substantial portion of the position was so-called in a cleared entity. Both the NYMEX Clearport and the ICE exchange on their cleared swaps, in their role as a credit provider to the energy marketplace, they bring a lot of that function in, right, and the business was cleared. But ICE
doesn't report. Right?
No, they don't report. But on the other hand, if you don't have position limits, it probably just would have made things happen sooner. Had more people known that you had one guy who had, a really big position that, maybe was tipping in the wrong direction. I don't think it would have prevented it. The only thing that would prevent it would be position limits. The question is, by definition, how do you have position limits on over-the-counter, unregulated markets? And if you have to, report the positions here, in the U.S., you'll just drive the business, to some place that doesn't have the same reporting requirements.
Possibly. Does anyone in the audience have any thoughts on that? Position limits or risk, or should there be transparency on over-the-counter markets in some regard? Yep.
But wouldn't it be one case that if you had an energy hedge fund that would say either, okay, I will only trade over-the-counter report, clear for trading, number one. So in the end, it might be that the investors in hedge funds will demand that you, as a hedge fund, only invest in it so that I have transparency. That it would be one way if you let the consumer take care of it.
Well, if you push the business to an entity like Clearport, you'd help the hedge fund investors in that they would be taking market risk but not liquidity risk. They'd have the function of the clearinghouse. you'd help Salish and the modelers of the world, in that you'd have the price discovery. You'd be able to see, so many MMBTUs traded at such and such a price on Clearport. But I don't see how that, without a position limit, I don't see how that stops someone from taking a position that's big enough to lose their capital base. And Amaranth, is a unique situation that it was so many billions of dollars. But who's to say that there aren't, scores of smaller companies that have lost their capital base that, the market really didn't pay attention. They had a 20% drawdown or a 30% drawdown, enough to close their doors because they lost, $10 million, which the market didn't notice, but their investors did.
There were a lot of people who, who rode the coattails of Amaranth, and we'll find out soon how much they lost. The amounts may not have been substantial, but they were significant. But the problem is this speculative activity basically drives the market away from its fundamentals. And that means a lot of people who have got hedging motives, they cannot take positions, they cannot hedge their risks. And then this starts a debate as to whether the prices have been artificially driven up, and that's what we heard last year, and we'll hear it again. So the question is, then you will get regulation on your backs. So the question is, which is better? Is it self-regulation is better? Have more price and transaction information released? You can do it with a delay, with a lag, protecting the confidentiality and everything else. But if you do not have that, there is a lot of speculation which is rife. Every day we would hear that Amaranth took this position, and then we would say John Arnold took this position. We did not know what the truth was. So some people said, hey, I trust this guy more, so I'll take position which I think he has taken. So it was like copycat. Lots of people put positions. So there was really no fundamental analysis of the market or anything. It was just wild speculation. And that is not what the market was designed for or was supposed to be. Amaranth going down, I have no problems with that. It was, in the great scheme of things, the people who invested were not stupid. They were highly sophisticated investors, large institutions. They gave the money. They knew what they were getting into. They expected Amaranth to take extraordinary risks and give extraordinary returns. You can't get a positive alpha so cheap with nothing. I mean, that's nonsensical. Yeah.
This question is actually posed to Mr. Kleiman. You had suggested that the transparency that was available to the market led to the fact that people were able to determine what they were doing and perhaps act against traders at Amaranth, and may have limited interpretation. But if so, wouldn't the opaqueness also serve a link function to the market participants?
I'm not sure if I overstated it or if you overstated, what I said. I don't think that the market necessarily knew exactly what their participation in the market was, but I do think that their level of activity was such that people were aware of, the types of transactions that they were doing and the fact that they were a very big player. I think it is interesting to me that, sort of in the post-mortem of what went on, people who did become aware of exactly what the size of the positions were and the magnitude of them were completely astounded. It would be as if I said, boy, I think they have a really big position. I think it's X, and it turns out that it's 1.5X or 2X, and so there was, I don't think that people necessarily knew exactly what they were doing, but they had an inkling that there was something big going on.
It's 20 or 40X. Two contracts.
Randy, I'd like to make a quick point when you talked about ICE and it's being opaque. During my time at the Commission, we actually negotiated what we came to call friendly subpoenas, which was basically that they had restrictions on what they could show, and it required a subpoena to show it. But we said, we can do this the hard way or the easy way, and we basically reached an understanding that in the course of an early investigation, we would come in with a subpoena, but it was something that ICE was willing to live with rather than the alternatives, which is where
either Congress or the Commission was likely to have gone otherwise. So there have been instances where, if you will, something along the lines of self-regulation have made some progress.
Okay. Some other questions? Yes?
I'd like to know maybe from Mr. Rahu, how much, given the lack of transparency, how much of your total view of risk in this game is on the benchmark side? Do you have any trust in these benchmarks at all, or do you trust them more than you trust all the other list of risks that you gave before?
Some commodities, some trading platforms, some contract months, we have a greater reliance because they are quite representative of the market. So those we use benchmarks, and there's a general tendency for the market also to do a lot of contracts which are against those benchmarks. So there are a fair number of benchmarks, but then there are a lot of other contracts or commodities and locations, etc., where the benchmarks are highly suspect. The transactions, especially in the natural gas back in 2000 and 2001, they were terrible. I mean, the transactions in the Rockies in the West, they were highly manipulated. So as a result, what do? You're a trader. You have customers you want to serve. You have to buy the commodity or sell the commodity at whatever the price is, which is sort of set by so-called people who are self-reporting to an entity which was supposed to be doing the cleaning up of the data and make sure that the prices are truly reflective of the transactions. Well, they weren't. And so as a result, if you've been reading the papers in the last few months and years, there have been so many indictments which have been given against the traders and the people who are involved in manipulating that. So question is, now when I want to start energy business and somebody says we want to trade storage in somewhere in the West or out in Louisiana or something, I have to build a model, right? So of the data, the historical data which I have, how much of it can I use? Can I use 2000 and 2001 data? It's rubbish. What do? So I have a very small sample. From a very small sample, I'm building up a model and trying to price a transaction which runs into millions of dollars at risk. So I am extremely concerned about those kinds of things. So, okay, what has happened has happened. At least going forward, can we do a better job? That's what I am concerned about. And I'd rather do it on a self-regulatory basis, on a voluntary basis, than being regulated by somebody who doesn't understand the economics, but understands the political implications of it. So that's the dilemma we are in right now.
Yeah, let me follow up on Salish's remarks, because I think the self-regulatory solution on that price index problem really worked very nicely, which was industry and the publishers came to the regulators and said, we recognize this is a mess, and we're going to take the following steps. And the publishers agreed to be audited. They agreed to do error correction. They agreed to give some insight about the number of transactions, and so you knew it was more than just a conversation between a trader and the reporter. On the other side, people agreed to stop letting the traders do the price reporting. It would come from the back office or the mid office. It really was a major quantum leap forward, and it was done largely by industry. But I remember my role in this, which was whenever industry got hung up, they'd roll me out into the meeting. I'd go, gee, looks like you guys are stuck. I guess the commission's going to have to help on this one. And then I'd leave, and then they'd break through and come up with a compromise on that issue too. So really worked pretty nicely. But
just a final on the risk issues of hedge funds. Do you think there's an answer at the end of the day? I mean, you have a risk officer at a bank who has so much power, And you have a risk officer at a hedge fund that really doesn't. I mean, he can say to the head guy, to the chairman, what's going on, and I'm sure that it's not rocket science to know there might be a problem. And in Amron's case, it got very extreme in Mother Rock and some others, one other in London I'm thinking of. What can one do? Any thoughts here? Anybody in the audience have any ideas? Or there's no answer, really?
I think they had limits, but those limits were very flexible. If you're making money, then we'll raise it. If you're losing, maybe you can do it better, so we'll keep it. So sometimes you don't have the luxury of time that things revert to the mean. That's how you got caught. So the question is, setting limits is fine. The question is, how strongly can those limits be held to?
The risk officers leave. A friend of mine left a major hedge fund because he couldn't take it anymore. No one really listened to him.
That's true.
You know.
Which is probably a good sign for the investors that they might want to do the same. But, and that's, and ultimately, in the hedge fund industry, that is, the ultimate regulatory scheme, which is, the investors,
really have to watch it themselves.
The investors have to watch it for themselves. It's their capital that's at risk. And, if they are not convinced that there's adequate risk management going on, then,
right.
They vote with their feet.
But it's really not just, those sophisticated investors can lose their money. It's their privilege, but it's really everyone in the periphery around them and how it affects the marketplace as a whole. Let me just ask Rob, with regard to the climate exchange, what would you say are some of the fundamental price drivers in the various emission markets?
When you look at the emissions markets compared to the energy markets, some of the price drivers would be, first of all, the relative cost of fuels. If you're going to look at natural gas versus coal, as nat gas prices go up, people will switch to using coal, the cheaper alternative. As you burn more coal, you produce more emissions, whether it be SO2 or carbon. So the relative price of fuels is a strong fundamental driver in the emissions market. Secondly, you take a look at heating and cooling days. Very hot summers, you use more power. Very cold winters, again, you're using more power, so the emissions would go up. GDP is another aspect that factors into pricing in emissions markets. As the economies expand, more production, more power use. And then finally, you'd have to take a look at the political arena. Regulations, environmental regulations tend to tighten over time. So you want to keep an eye on the regulations that are being promulgated in the individual markets. You never put more arsenic in the water. So when you look at environmental regulations, they have a tendency to start at a level and then over time ratchet up. In the SO2 market in 2010, regulated entities are going to be required to deliver 2 allowances for every ton of emissions. Currently, it's a one-on-one basis. So that's a bullish effect on the price of allowances. So that's what I would say were the main drivers of emissions.
Okay, thanks. Some more questions? Yes?
Yeah, I'm actually back on Amron. Sorry, going into the emissions.
No worries.
So, Amron or whomever, I'm on kind of the bigger side. How do you, given all the measurement issues that people comment on, how do you, and the model risk, how do you set limits? Let's say you can't enforce this. Let's make that up. How do you set limits that, even though you may lose some money, are not going to control your institution? And I was asking you about that.
Are you talking from the point of view of somebody who is managing a fund like Amaranth or somebody who is a counterparty to Amaranth? Counterparty to Amaranth, well, you're always acting with very limited information. You do not know what the counterparty's positions are with everybody else. So you take into account what their capitalization is, right? They give you some financial information. You can insist on giving the volatility of their P&L or something. So on that basis, you make your decision, how much money you are willing to risk with one single counterparty. That is no different from any other counterparty, whether it is Amaranth or energy or financial markets.
Right, but let's say you leave some information. Joe actually is, on my trading desk, and he actually tells me some of what's thinking. Let's say that happens. And he expresses some vague concerns about liquidity. How do we think about and measure liquidity premium or liquidity discount, or whatever those words you want me to use, when what is in the small size a relatively liquid contract, but in the big size is clearly not comfortable with. How do we factor in discount? Do you think?
I think that from a practical point of view, the market doesn't do a very good job of pricing that in. When we went through, the first round of, the post-Enron shakeout in the energy trading business, I made a comment to a friend of mine once. I said, it's very interesting. You can call someone for a price, and, you state a quantity, and you ask them to make you a price, and they'll make a price. And the price that's quoted never reflects the credit quality of the person who's asking for the price. The person doesn't say, well, before I give you a price, let me see, were you just downgraded by S&P? Do I need to make a wider bid ask for you? And in fact, that doesn't happen. And so you really get into situations where, from a practical point of view on the trading desk, you will have situations where the credit officer comes and says either, no more positions with this person, or liquidation trades only, or cleared trades only, and that's the way in which the market deals with it. But to a certain extent, the way it gets dealt with is on an ex ante basis of setting the limits. I think that if the credit function is done properly, the limits are such that even if the counterparty were to completely default on the obligation, that it wouldn't be material to the health of the organization. In the same way that a trader, if they're doing their job properly, and traders tend not to do it as properly as the credit officers do, the traders don't put a position on that in and of itself jeopardizes the book. It's the only way, because you don't know, if you have 10 contracts on with the counterparty, you don't know that, whether he has 10 contracts on with everybody else on the street or not.
Well, you can, if you want to be specific, you can add a credit charge. You put a credit charge by counterparty capitalization and credit rating, and then you hit the traders with that. So then the trader will, he's not going to give the same bid offer spread to every counterparty. He knows that, he has, for this counterparty, who is a marginal counterparty, he has to charge more to buy at a deeper discount.
But the charges will go up as the position goes up. They still make the same charge for here, right? Counterparty and expected loss or expected exposure.
You can charge on expected loss. I think our risk people will tell you that they can calculate to the nearest penny or the nearest tenth of a penny. How good it is, I don't know, and how much you can do it, and the traders will scream for sure. But you can do that. But usually you do it on a portfolio basis. You say, okay, this is the average credit quality which I want to maintain, and on that basis you charge on a portfolio basis, because on a desk level you can't really implement it.
Okay. Thank you. Go ahead.
There was a mention at the earlier part of the discussion about bills regarding emission control, things like that, and that this in turn would feed into possibly models, climate effects, and everything else, political situations. China is currently, their demand for energy is growing exponentially. And from what I've heard anyway, is that their approach to providing a solution to this are coal-fired plants. And that there are coal-fired plants coming on at some incredible amount, one a day, or maybe so. How can we pretend we say that we have models on these things at all? I mean, we can't predict interest rates. We can't predict just about everything out there. But nevertheless, it seems fundamental to dealing in these markets that you've been talking about today, that there has to be some kind of model that isn't just running away towards more and more coal emission energy.
No, you want to take a crack at that?
Yeah, that's obviously a tough one, and that's one of the reasons why the U.S. didn't sign Kyoto, right? China and India, the two major other partners, didn't sign. Australia being another, but not clearly the size. It's estimated that the U.S. is the largest producer of greenhouse gas emissions. It's estimated by as early as maybe 2009, China passes them. But I don't think the solution is to say that if China's not going to join or do something about it, at least in the first instance, that the rest of the major trading partners shouldn't. I think that the way that you regulate something along that lines is you take the position that if you want to be a world economy and you want to export your goods to the world economy, then you have to be a responsible player in that world economy with regards to other parts like emissions. So potentially you don't buy Chinese goods if China continues to export its emissions along with its products. So I don't think that necessarily the U.S. to take a stick their head in the sand approach, because China is not involved at this point. Secondly, by developing a carbon market, one of the key aspects of developing markets is that you send price signals. And those price signals can then be attached to investments in technology and investments in reduction technologies, and also an export of new technologies to move beyond the coal burning and maybe help in the development of clean coal. Coal's always going to be part of the power source. It's the low-cost alternative. It's the energy source that's most prevalent. Coal will always be involved. But when you factor in emissions markets that send price signals, you then give the ability to price in new technologies to help develop these cleaner technologies. And hopefully you can export those technologies.
I'd just like to follow up briefly on that, because I think on Rob's last point, the key there is that it's not, if you will, just a stick for China. It becomes a carrot for China, because people from OECD nations will be willing to pay for those reductions in China if they can get certified and get the credit for the reduction. So that's a big part of what gets it to work.
China is one of the largest areas in the CDM, which is the Clean Design Mechanism of Kyoto. Chinese projects are one of the largest areas of creating credits for the European market. So investment dollars are going in there with the hopes of creating cleaner technologies. Yes?
Maybe this is a question for both Rob and Bill. Are we going to see on CO2 that it will basically follow SO2, where plants will then be just given allowances? So if that's the case, it's going to be noise for a coal plant. You're not going to strike the coal still be in the market.
That depends upon the bills that we're looking at, but I would imagine that that would be the case, that there will be an allocation given a stream on a reduction schedule. So the idea is that you cap them at a level, and then you give a forward stream in a reduction.
Right, so anybody who's got an existing power plant who's sitting on an air permit and out of appeal are going to be given CO2 allowances.
They're going to be given allowances, but the idea is that they're going to be reduced over time.
So it'll be a phase 1, phase 2 like this.
Most likely, yes. Typically, when you look at environmental regulations, that's how they occur. You're given an allowance, and then there's a ratcheting down over time. The allowances tend to be in the early stages, not freely given, but more widely dispersed, because that's how you gain acceptance on a broad base.
Of course, the problem is, unlike SO2, there's no scrubbing, right? There's no way to scrub out the CO2.
That's exactly right. In terms of technology right now, there's no way to scrub out CO2. And that's why the market becomes important, because and outside of just the utility market, a broad-based multi-sectoral approach. Because if you take a look at global warming, there's 6 major greenhouse gases. If a technology company or a chemical company like DuPont can reduce greenhouse gas emissions of another type for pennies on the dollar, they should be encouraged to do that. And the utility that doesn't have an option with coal should be able to buy their allowances. So that's the idea of a cap and trade market, is you spread the cost of compliance to the lowest denominator until the time where technology does exist for the CO2, whether it's carbon sequestration, geological sequestration, or whatnot.
Yeah, just briefly, I was part of putting a program in place when I was at Columbia Gas Transmission to start the methane reductions and start documenting it, to start getting credits to be able to take advantage of them as pre-build, if you will, reductions. But there, on the carbon stripping, there are some very promising technologies now at the lab scale, and I think once there's a commercial imperative, I think that there's a high likelihood that they'll come up with some scrubbers, if you will, pretty quickly.
Okay, go ahead.
This is a question for Mr. McAndrew. You mentioned that the price ranges for SO2 emissions, for example, were really great. Are there any steps they're taking, like to decrease the volatility in the market, build some kind of models to predict it so that it becomes more attractive to investors?
Well, I think the volatility is what's attractive to investors. One of the aspects that I didn't mention when you're talking about price points is you have to take a look at mitigating technologies. The gentleman over here mentioned scrubbers. So what's the cost of abatement, at which point a company would put in a scrubber over paying for allowances. So that's another area that people tend to track, is to look at what's the cost of technology to employ. Scrubbers it's predicted, said to cost anywhere between $750 and $950 a ton to employ a scrubber. The time lag of being able to put a scrubber in, and for some utilities, they just don't have the physical space to put a scrubber in. So those all factor into the price as well. But I think, the markets are what smooth out prices.
Okay. Did you have a question?
I think this rolling over into atomic energy, that are we going to see trading of radioactive waste funds, or are we going to see? Are people going to start? Have people ever mentioned peak uranium? Is any of this going to flow over into that? Because that seems like what everyone's talking about is that's where people are going to be pushed.
A free market economist will tell you that there's a market solution for everything. So, I don't mean to be facetious, but we're in the process of exploring markets for, there will be a cap and trade market for mercury. We're in the process of exploring markets for water. We think that in the next decade, the water markets will be significant because as you price commodities, it's the only way that you can control their use.
I just want to add that if I remember correctly, I think over the last 5 years, the price of uranium has outperformed the price of both natural gas and crude oil.
That's right.
And I also think that, yes, people will trade it. And you can fill in the blank, whatever it is that you want to talk about at that particular moment. People will trade it. And that's one of the things that we've seen in the markets. People are coming up every day with, more things to trade.
You just need to be licensed by the Homeland Security Department. But radioactive waste is traded because most of the isotopes and all, which are medical isotopes, are produced using that.
And there is, if you will, a climate change initiative within China. There, I think they have the most nuclear power plants under planning and active development of any place today.
Okay, thank you. Another question?
Yeah, I was hoping to go back to the transparency questions. I was wondering, if, I guess maybe Joe Kleinman, what the impact might be in trading opportunities now that the CFTC reported that the trader reports is going to be more careful. The definition of hedgers and speculators, separating out the index investors. Maybe if you could comment on that, and whether the CFTC should report finer granularity. Apparently, the exchanges and the CFTC do collect more classifications than it's just reporting. And then just for level playing field, whether the ICE should report positions, especially for things that are next to flex.
We were chatting about that earlier.
I'm all for it.
Well, up everything you just said, actually.
Yeah,
But,
I certainly wouldn't mind seeing better granularity to the data. I think that some of it is misplaced in that like I said before, you can go through and do the math and sort of see what the index participation is in the markets. But it would be better if it were official data that were released. And I'm all for it. As far as should ICE live under the same rules? Far be it from me to say that they shouldn't be. Why should they be any different? I don't necessarily think that people do business. I've certainly never had an encounter with somebody who said that they preferred doing business on ICE over NYMEX just because their information wouldn't be included in the CFTC report. So I don't think it would hurt the market.
I had just one question for Salish. I think it's more for Salish. How exchange versus OTC trading may impinge upon transparency and index construction? I think that's up your alley.
Well, exchange traded, I mean, if the OTC transactions are captured by some unbiased independent party, like University of Houston maybe, like CRISP, for instance, which releases the data on that, I would have no problem with the OTC transactions. Exchanges do a pretty good job of reporting the transactions, the volumes. They have good controls and everything else. I don't see why, if ICE is doing nothing but NYMEX lookalikes, every time NYMEX has a contract, they go out and create one. I don't see why, just because they're domiciled in London, that they should not be regulated here and should be reported.
But there's a concern that if you regulate these entities, then all the business will move offshore.
Well, the regulation, that's why I said self-regulation. ICE will probably, I do not know. I think it's probably debating right now whether they should join and report the transactions. Because CFTC's, I thought they had a meeting last month, a couple of months ago, about the CFTC commitment of traders, and IEA has come up saying that you need more information. So there is a move towards it, and I think people are seeing, given the political changes, maybe we should do something on our own.
Okay, in the back.
Hi, I work for ICE, and we are heavily regulated, we believe, by the FSA of London, and we have a good working relationship with all the U.S. agencies, including CFTC, FERC, Department of Justice. In fact, our power indices are the only reporting service that FERC says complies with FERC's guidelines. So we think we're very transparent. The CFTC Ribbon of Traders report is being reworked because everybody recognizes that it's pretty arbitrary in some of the classifications. So we're not sure exactly what you'd like us to do in terms of reporting until the CFTC really looks at it.
Any comments?
Why can't you report what volumes and positions which NYMEX reports on, say, nat gas or on crude?
Well, on if you look at who's a non-commercial, the NYMEX versus commercial, and I understand your early comment about the fundamentals not necessarily being reflected. You can make some argument that some huge percentage of the commercials are really non-commercial.
Mm-hmm.
I'm not sure where your institution fits, but you may actually be a commercial in terms of reporting terms. So if a hedge fund comes to you and says, I want to buy, $5 million crude oil from you on a bilateral basis, and then you turn that to the trading desk and they put it on NYMEX, that's a commercial position. But we all would agree that it shouldn't count as non-commercial. So what does the data mean? And the CFTC recognizes
So once the CFTC addresses that issue, I should have no problems reporting.
We enjoy regulation by the FSA and the EPA. We cooperate with every agency, and as we pointed out, things may change in the future.
But I must point out, 10X service is very good.
This is another issue of our opacity. Our natural gas and power markets run our OTC cleared side of the platform, which has some barriers to trading. You must be eligible for commercial entity trading in some platforms. But once you do, you see every trade that's done. I mean, it's done completely anonymously, but in terms of someone trading 6 months for a spread, you see all the volume that's done on that spread, trade by trade, and we have a data service that actually sells records of the electronic trading. So that is, again, one of the reasons why FERC said we need guidelines, because if we're not a reporting service, we actually have every trade that's done, possibly forever, on our platform, provided to the other agencies.
Okay, thank you. Maybe another one or two questions. One question for okay.
Question for Robin and Bill. What is the mechanism that's in place to regulate or ensure that someone is reducing their emissions versus business as usual? As to they are actually
in the U.S. under the Chicago Climate Exchange, which is a voluntary market, all the members filed annual reports, which are verified by the NASD, an independent auditing company. So the bills are actually looked at. The data that is submitted is actually looked at. In the EU ETS, it falls under the regulatory scheme of the individual national allocation plans to look at the data that's submitted by their entities. So the data is reviewed independently. From a standpoint of projects that are producing credits, those projects have to be independently verified by in-the-field auditors, and then those reports are verified on another level. So there is independent verification of all these reports.
Just to draw an analogy, in the SOX area, EPA has put continuous monitoring in place. So one would expect, if it becomes legislated, that there be something quite similar put in place too, that it be less likely to be private sector auditors and more likely to be some kind of monitoring equipment under EPA oversight.
Where practical, if you have a smokestack, you can put an emissions monitor on it. Currently, these emission monitors that are in place do pick up CO2 emissions, so those can be monitored. But you can also pretty well calculate where emissions come from fuel use and records along that line. So if you have an entity produce their fuel purchases, for example, you can calculate what their emissions were based on that.
Any other questions? Anything from the panel that you think we'd like to address? No? Okay. Well, thanks everyone for attending. Appreciate it.